Let's start with where you left off pretty much a while ago, which was that your assessment of the coronavirus impact was one more on sentiment rather than on fundamentals and on pricing. Has that evolved since?
Well, we haven't seen any change to the basic fundamentals. I mean, price is holding up well. We have seen some supply-side disruptions more recently due to weather events, either in Brazil or in the Pilbara here in Western Australia. So from our perspective, we're still shipping as per usual. And that was the comment we made recently with our quarterly, that we are continuing to ship as per our schedule, and we are still seeing that strong demand. Iron ore inventories at ports in China are not actually increasing, so that iron ore is also being consumed. We know that there are some challenges for the finished products, so some of the challenges around transport and logistics of moving that finished steel product to the construction sites. There are some challenges there, but at the moment all of our customers are still producing steel, and as I said, we have seen no change to our schedule for our shipments.
We've seen some China clients declare force majeure in the commodity space. Is there a possibility that that could start trickling through into the iron ore space as well?
Well, we certainly haven't seen any customers declare force majeure at all. And as I just said, our schedule of shipments is continuing. We're working very closely with our customers. They are all still producing steel. So at the moment, the fundamentals are demonstrating that there is still ongoing steel production. And that comes off a record year in 2019, where Chinese steel mills produced 996 million tonnes of crude steel, and that was up 8.3% compared to the previous year. So we're seeing that ongoing strength in the steel sector. As I said, this is a period of rather subdued activity anyway due to the winter seasonal period. We would expect construction activity to really pick up come April, May. So we'll be watching that very closely and monitoring the situation.
I mean, markets got quite a bit of a shake-up from the outbreak of the coronavirus. In your conversations with clients, what are they most worried about when it comes to the coronavirus?
Well, I think in conversations with clients who are effectively our steel mill customers, their biggest concern is some of those logistics that I just referenced. So the transportation of steel to the construction site, to the property development, that is some of the challenges they're facing at the moment. We certainly aren't seeing any impact on the unloading of our ore carriers in China. So the iron ore has been unloaded. We're seeing that iron ore being consumed, but I know for the steel mills there are those challenges around some of the transportation and infrastructure. So we have seen steel inventories increase. But given that strength of last year of 996 million tonnes of crude steel, the level of steel inventories at the moment is very modest compared to that overall production in 2019. And I think importantly, the Chinese government have already indicated that they are determined to achieve their growth targets for 2020. And a lot of that stimulus will come through infrastructure investment. Infrastructure investment tends to be very intense in terms of steel demand, and that underpins that ongoing demand for seaborne iron ore.
I mean, I was going to follow up on that, Elizabeth, and that is basically whether or not these massive stimulus measures from the Chinese government might actually turn out to be a net positive for iron ore prices, despite the outbreak and the ongoing concerns around the coronavirus.
Well, there's no doubt that history has demonstrated that when the Chinese government announce these stimulus measures, they do tend to be focused on infrastructure investment, whether that's additional rail projects and other major infrastructure investments. And as I said, they tend to be very steel intensive. So I think you're right. Those big stimulus measures that are focused on infrastructure are actually a positive for steel and therefore for iron ore. And we have seen the impact of some of those supply disruptions as well, where we've seen some of our other producers who have actually indicated that they won't meet their targets this year. So you've got some disruption to supply, coupled with the potential for some additional stimulus measures and that investment in infrastructure.
What about doing some deals in other currencies? Because there's some new firsts in trade of seaborne cargoes. Those have been done in yuan. We've seen Brazil's Vale move a little bit on that. What's holding you back from trying something similar?
We already have done that. So we've established our own trading entity in China. So we're actually delivering iron ore directly from ports in China, and we're selling that in local currencies. So we started that initiative in June last year, and for the first half, those volumes are tracking towards 3 million tonnes of volume that we've sold through our trading entity. So we are dealing with those customers that we know would prefer to actually transact in local currency. Tend to be the smaller steel mills, and they want to buy smaller parcels of iron ore rather than a large seaborne cargo. So we're already dealing directly in local currency.
As you look to 2020 and maybe even beyond that, what are you most excited about that could be a great catalyst as far as new sources of innovation is concerned?
When it comes to innovation, we're already on a path to innovation. So this year we will complete the conversion of our autonomous haulage, or of our haulage fleet, to autonomy. So we will be the first iron ore producer globally to be fully autonomous for our haulage requirements, and we'll achieve that towards the third quarter of this calendar year. So innovation is really important at Fortescue, and I think we've been an industry leader in terms of our approach to innovation. So autonomous haulage, we've already travelled over 40 million kilometres autonomously without a driver, and we've seen the safety benefits, the productivity benefits. That's one of the reasons why we are the lowest cost producer globally, at less than $13 a tonne for our C1 costs, and for this half we're at $12.73. So innovation is really important to us. We're excited about the benefits and the productivity improvements. Maintaining our industry-leading cost position is really important to us, because we know that when the market goes through cycles, being the lowest cost producer ensures we can continue to deliver very strong margins, and that's obviously driving those incredibly strong results. We just saw a 281% increase in net profit after tax to $2.5 billion in this half alone, and a big contributor to that is our innovation and our cost performance. And we're also investing in energy innovation. So we've announced 3 major energy projects in the last few months, and when they're completed, up to 25 to 30% of our stationary energy requirements will be powered by solar. And that's a really important part, not only of our cost journey, but also of reducing our emissions.